All right, today we're going to take an investor's deep dive into an aerospace and defense giant that might just be flying under your radar. The company is Safran, and we're going to try to figure out why so many people consider it one of the highest quality businesses in the entire world.
But first, I want you to think about this question for a second. Seriously, what if you could own a piece of a global duopoly? Because when we're talking about Safran, we're not just talking about some company that makes cool high-tech stuff. We are talking about a company that holds one half of a totally dominant position in a critical global market. And, from an investor's perspective, that changes everything.
So how in the world did they build this fortress? Well, the key to understanding Safran is to really get a handle on its competitive advantage, what investors call its moat. And Safran's moat is built on the rock-solid foundation of an incredibly powerful, long-lasting partnership.
And that partnership has a name, CFM International. It's a 50-50 joint venture with GE Aerospace. And look, it is no exaggeration to call this one of the most successful industrial partnerships ever. For almost 50 years, these two have just completely dominated the market for engines that power single-aisle jets, the workhorses of global aviation. Think Boeing 737s and Airbus A320s.
So what makes this partnership so insanely profitable? It's their business model, and it is absolutely brilliant. And hey, if you've ever bought a printer or a shaving razor, you're going to get this instantly.
So here's how it works. Step 1, you sell the engine. That's the razor. And you often do it at a really low profit margin, sometimes barely breaking even. You just want to get that engine on the plane. But then comes step 2. You service that engine for its entire life. We're talking 20, even 30 years. That's where the real money is made. You're selling the high-margin blades, the spare parts, the service contracts for decades.
And if you want to see just how dominant this model is, look at this number. CFM's next-generation engine, it's called the LEAP, has already snagged a staggering 72% market share on new narrow-body planes. I mean, think about that. For every 4 of these new jets rolling off the assembly line, about 3 of them are powered by Safran and GE. It's incredible.
And here's the thing that should make any long-term investor's ears perk up. This isn't some short-term advantage. Nope. Safran and GE recently extended their partnership all the way out to the year 2050. This is huge. It basically locks in their duopoly and that river of high-margin aftermarket cash for a whole other generation of aircraft.
Now, that long-term moat is powerful enough on its own, but what's happening right now is something else entirely. Safran's most profitable business is smack in the middle of a perfect storm. The industry's even got a name for it, the aftermarket supercycle.
So here's the setup. On one side, you have air travel demand just going through the roof. We're now flying more than we did even before the pandemic. But on the other side, Airbus and Boeing can't build new planes fast enough. They're facing these huge production delays with a record backlog of more than 17,000 planes.
So what happens when you have tons of people who want to fly but not nearly enough new planes? Well, airlines have to keep their older jets in the sky for longer. And this whole dynamic has created what they're calling a supercycle for the MRO market. That's maintenance, repair, and overhaul. And the effect is pretty simple, right? Airlines have no choice. They have to fly their existing planes harder and for longer. And that means a huge boost in demand for Safran's most profitable stuff, spare parts and services for their massive fleet of older CFM60 engines. This creates this incredibly lucrative cash bridge. I mean, just look at the result. Their civil aftermarket revenue shot up by almost 25% in 2024 alone.
That cash bridge we just talked about, it is so important because that money is being used to fund the next wave of growth for the company. So let's take a look at what's coming down the pipe.
Safran has a really clear roadmap laid out. Right now, that legacy CFM60 fleet is the cash machine. But a massive catalyst is just around the corner in 2025. That's the year the service contracts for all those new LEAP engines finally start hitting the books as profitable. That's a huge new stream of earnings. And if you look way out, their next-gen RISE engine program is designed to keep them on top well past 2035.
Now, engines are definitely the main story here, but they are not the only story. Safran actually has another growth driver that's been a fantastic turnaround. Its aircraft interiors division. The part of the company that makes seats, galleys, all that stuff inside the plane?
So for years, this division was losing money. But now, it's actually profitable. And it's being driven by a huge recovery in deliveries of their most valuable products, like business class seats. Get this. Deliveries more than doubled in just 1 year.
This successful turnaround has turned what was a financial drag into a genuine new source of growth.
Okay, but no investment is a sure thing, right? To get a balanced picture, we absolutely have to talk about the risks, the potential headwinds that could get in the way.
The single biggest risk, without a doubt, is the fragile global supply chain. These disruptions aren't just slowing down the production of new LEAP engines. They also make it way harder to get parts for repairs. And think about it. If an airline's engine is stuck in a repair shop waiting for one little part, that plane isn't flying. It's not making money. And that can really frustrate customers and put pressure on Safran's super lucrative service revenue.
So beyond the supply chain, there are a few other key things investors are keeping a close eye on. First, you've got the simple fact that aviation is a cyclical business. It goes up and down with the economy. Second, there's always competitive pressure, especially from Pratt & Whitney. And finally, Safran just has to execute perfectly on this really complex transition from the old engine profits to the new ones. It's not easy.
So, you weigh the incredible opportunities against those very real risks. And what's the bottom line for an investor? Well, it really comes down to two things: value and returns. This table right here does a perfect job of showing where Safran's real value is. So the engine division brings in about half the revenue. Okay, that makes sense. But here's the crazy part. Analysts estimate that same division accounts for up to 70% of the company's entire enterprise value, basically what the market thinks the whole business is worth. That just screams how much investors value that defensible, high-margin, recurring revenue.
And look, management isn't just talking about creating value. They're putting their money where their mouth is. They've just announced a brand new share buyback program, and the number sends a really powerful message to the market: 5 billion euros. And this isn't some one-time thing. It's actually a core part of a multi-year plan to return about 70% of all the free cash flow the business generates directly to shareholders. That's through dividends and these buybacks. It's just a crystal clear commitment to giving cash back to the owners of the company.
Which, of course, brings us to the final question. You have a company with an incredible, locked-in market position and a very clear plan to reward its shareholders. The market knows this, so the stock usually trades at a premium price. So the big question for any investor is this: is that premium valuation actually justified by what looks like a very, very long and profitable runway ahead? And that is something to think about.